All right, ladies and gentlemen, let's kick off. So we are talking about how to grow your money through investments. So we're going to cover a few specific topics. We're going to look at what is wealth, what vehicles do you have, why is diversification important, and what is risk, and the difference between investing and trading. Again, this is information and guidance and education only. This is not any sort of recommendations. Anything that we mention is for educational purposes only. It is very possible for me to get in trouble with things like this. So I have said what I have said. Let's move on. All right. So what is wealth? Wealth is all about your lifestyle and the legacy of what you do with your money. I am going to explain this graph because I want to show you, if there's only one thing that you get out of this session that we are going to have together, it's that not every pound is created equal. Pounds, depending on how you use them, will give you more or less wealth. This is the biggest lesson of the day. So I've got three different scenarios. In all three scenarios, you have £2,500 worth of debt, which has a 19% interest rate, so probably a credit card. You have a savings account, which is paying 1%, which you will all know right now would be a very good rate to be getting. And you've got £200 a month, and you're trying to figure out what to do with it. So in this first scenario, we're going to assume that you save £100 and that you pay off your debt with £100. If you do that, as you can see, over time, you pay off your entire debt, which is the green, the total liabilities, and you build up your savings, your total assets. And at the end of 31 months, you have £3,036. So you have £200, and the way that you are paying off your debt and doing savings means that you have £3,036 at the end. Very good. But what if instead you were saving only until you had an emergency fund, and then you were paying off your debt as quickly as possible? As you can see here, you pay off your debt pretty quickly in half the time by month 17, and then you put all of your money into savings, and at the end, you have 3,380. So you have 10% more wealth, even though you've had exactly the same amount of money at the beginning. You still only have £200 a month to put in, but you've come out with 10% more money. And the reason for that, hopefully you will all gather from this, is because debt in this case is more expensive than you're paying a lot more on your debt than you are earning on your savings. Now, what happens if instead of £200 a month, you have £250 a month? You have over £5,100 of net wealth by doing exactly the same thing as you were doing before. You save only until you have an emergency fund. An emergency fund, for people who don't know, is the idea that if there's a problem, you have some money so that you can cover it. So your washing machine breaks or you've lost your laptop, you've got some money you can tap into. You pay off all of the debt as quickly as possible, and you then put everything into savings, and you end up with £5,150. The point of these three graphs, and the reason that I start with it, is to make a very simple point. Your money can make you more money or can make you less money depending on how you use it. And the accumulation of wealth, which doesn't have to mean rich, it just means that you've got more money that you own than things that you owe, will very much depend on how you use your money. So I've used it as an introduction. If there's any questions, of course, let me know. But let's carry on. If there's no questions, we can always come back to this. There's always some questions. But let's get cracking into how you get into the position where you're able to do these things. So how do you prepare? This graph is really how you get your money sorted. This is the entire financial journey of your money. You need to get your budget sorted. I know the B word, we all hate it. You need to get your budget sorted. You need to have a little bit of money left over. You need to pay off as much debt as you can, set up an emergency fund in case things go wrong. We've just lived through 2 years of COVID, things go wrong. Then save until you've got enough money to be able to start investing. Okay, so this is the financial journey that everybody has to take. It is very difficult to invest if you didn't first save. And it's very difficult to save if you have a lot of debt and if you're not managing your money well. So feel free to screenshot it. This is the map to starting to invest. And there are 4 different levers that you've got in your money. Now, what do I mean by that? You have income, which is money coming in. You have expenditure, which is money going out. You then have your assets, which are the things that you own. And you then have liabilities, which is the things that you owe. So think credit cards and payday loan debt and any buy now, pay later, car loans, mortgages, and the like. So the four levers that you have is how much money is coming in, how much money is going out, what things do you own that make money, and what things do you owe that cost you money. This is how most people around the world who are earning any income, this is what most people's financial position looks like. They have money coming in, and the vast majority of that money is then going out to pay for their life. So to pay for food and electricity, which everyone in the UK at the moment knows electricity is starting to get very expensive. And then a little bit of it goes into paying off debts. And then a teeny tiny amount of it goes into building up your asset base. Now that could be an ISA, and I'm conscious that some people in the room are not in the UK. An ISA is a special savings vehicle that's available in the UK, which I will be explaining a little bit later on, but that might not be relevant to you if you don't live in the UK. So most money goes into paying for life, some money goes into paying off debt, and then a very small amount goes into building out your assets. Really what we want is for people's life to look more, ideally, more like this, where a part of your income obviously pays for your life because there's only so much that you can cut. There are things that simply cost money. You need a roof over your head, you need food on the table, you need to pay for heating. But then where a lot of your income goes into building out your asset base, and a significant amount goes to paying off debt and hopefully getting to the end of owning debt. So this is ideally where we want people to get to. Now, this is a lifelong journey. When you're a student, your life is going to look more like this, like this, just because you don't have that much money coming in and there's a lot of money going out. The goal, of course, is that as you move through your life and you earn more money, that you are able to use your money in a way that makes your money work for you. Let me just check because we've got a couple of questions. This is very much like the rich dad, poor dad narrative. That's exactly right. And you can see in the bottom right-hand corner, this is pulled directly out of Rich Dad, Poor Dad. So we do give him credit for that. So in terms of your budget, these are the three options. So you've got money coming in the middle. On the left-hand side, you can see that you are spending more money than you have coming in. The differential there is where you get poor. Now we are using poor and wealthy as obviously the big headlines. Of course, you don't have to be poor if you're overspending, but what tends to happen is the only way that you can fund that differential is through debt. And the problem with debt is that if you are consistently spending more than you have, then that debt can become a cycle, and that is where people run into financial difficulty. By the way, I am not making a judgment call. For some people, this is simply the way life is, and that's a terrible situation to be in, and we need government policies to make a difference. So I'm not making any judgment on it. I'm simply calling it what it is. On the right-hand side, you've got less money going out, and the difference between the money coming in and the money going out, that is the money that you can invest. That is the money that can go into assets. That's where people can build wealth. So ideally, what you want to be doing is moving from a position where you're spending more money than is coming in into spending only what is coming in, into spending less than what is coming in, so that the difference there can start making you money. If there's nothing else that people can understand about budgeting, and for some people, budgeting is a very complex issue, at minimum, you want to be in the middle space where you are spending what you have coming in. That will get you to the end of each month. What it doesn't do is allow you any sort of space for there to be issues. So if a problem happens, or later on when you retire, if there's no point at which you are able to save and invest, then although you'll never run out of month, you may run out of money before you die, right? So you need to be building up wealth so that you never have to worry about running out of money before you run out of time. On YouTube, okay, great. Thank you, people who are answering the questions from other people. That's really helpful. I appreciate it. All right, so that is the budgeting. We're not going to spend a lot of time on it because it is just the top kind of layer. So let's start to dig into the investment side, which is why we're all here. So the first thing I want to talk about is diversification. Diversification is this idea of buying different things so that things can balance out better. And I'm gonna explain what that means. There are different ways of diversifying. The first is by region. So you can invest, for example, in Europe and America, in the developed world, in the developing world, in particular regions and the like. You can diversify by sector, so technology versus finance or food. By theme, defensive versus cyclical. Defensive means assets that work, that grow regardless of what's happening. Food is a good example of a defensive asset because people always need to eat. Cyclical are things that go up when the market is good or when the market is bad, and they go the other way under other conditions. So it's cyclical, whereas defensive tends to be more consistent. It also returns slightly less for, because it's less risky. By class, so you have shares and bonds, and then by risk profile, people who are who are into very high risk assets and people who are more conservative. There are a range of different types of assets that are out there, from the bottom, which are the most secure, to the top, which is the least secure, the most risky, the highest likelihood of losing money. And we're not going to go through these. These are mostly things that you wouldn't be touching anyway, like futures contracts. But I wanted to show that there are a lot of different types of assets out there. The question is, what is going to work for you? So how does this whole thing work at a very practical level, right? That's all very esoteric. Let's bring it down to very practical understandings. So you have an ice cream shop, an ice cream company, and it has 10 shares, and you've bought 1 share. If the company's value is £10, then the share that you own is worth £1. Let's say the sun is shining because you're in beautiful Cape Town as opposed to rainy and disgusting London. And the sun is shining, and so a lot of people are buying ice cream, and now the company's value is £30. It means that £30 divided by 10 shares, your share is now worth £3. You've had a 300% increase, right? That's great. But let's say that your ice cream company is actually in the UK and there's a massive storm and nobody is buying ice cream, and the value of the company goes down to £5. Your 1 share is £5 divided by 10. So the value of your share is now 50p, right? So you've lost 50% of the value instead of gaining 300%, right? When you diversify, you are buying into an ice cream company and an umbrella company and a hamburger company, so that no matter what the weather is doing, one of these companies should be performing well. So you've got ice cream when it's sunny, you've got the umbrella when it's raining, you've got the hamburger when it's cold, right? And so what you do is you can either buy 1 share in each company, or you can buy, for example, the weather fund. The weather fund, as you can see, is made up of all 3 companies. So regardless of the weather, you are making money if you hold on to the weather fund. And this is one way of diversifying. So instead of buying 1 share in the ice cream company and hoping that the sun is going to stay shining, you can buy 1 share in the weather fund. And although it will return a little bit less on average, no matter what the weather is, the fund should increase in value. And this is one way of diversifying. This also goes towards the question we asked right at the beginning about risk of individual shares versus funds. This is the reason why an individual stock is usually a lot riskier than a fund. If there are any questions, please let me know. I'm just going to check. If there are any questions. Oh, thank you for people who are saying nice things. Always like that. Thank you very much. Okay. So in the, yes, Jarell, go ahead with the question. Did you want to unmute or did you want to type it in?
Sorry, I'll unmute because it's easier. Thanks.
Of course.
That weather fund with this assortment of funds,
yes,
or assortment of shares.
Yes.
Is this what a company would do for you, or do you do that yourself, or both?
So there are funds that are available. There are tens, if not hundreds of thousands of funds out there. The question is, what kind of fund would you be interested in? And then you select it. So the fund manager which can be a single person, the fund manager will select what that fund holds. So the fund manager may decide that in order to have a well-run weather fund, he needs actually 2 ice cream company shares and 1 umbrella one and 1 hamburger one, because he's based in beautiful Cape Town and the sun is more likely to shine than it is likely to rain. Right? So the fund manager will make the decision. And then there are 2 different types of fund managers. There is an active manager who may make a difference in that. It's known as an allocation. They may shift that allocation on a regular basis, like once a quarter or once a month or in response to events, or a passive manager who may only make decisions once a year or once every 2 years. The active versus passive fund manager will be more or less expensive. When you buy a fund, you pay for the management of that fund because they are making that decision. And if you are buying individual shares, you won't pay because you're the one that's making the decision. Does that make sense?
Thanks so much. Thanks.
Beautiful. My absolute pleasure. Yeah, if only there was a weather fund, because in the UK, you'd just be buying umbrellas. It's all good. What if the weather fund fails? So great question. So if the weather fund fails, then it really depends on the regulatory framework within which that fund exists. So it could be a case of you lose all your money, and this has happened. It could be a case that it starts to trend downwards, and I'll open up a live example so that you can see. There is always the possibility of things failing, always, right? There is no such thing as 100% guarantee, even Amazon, right? Less likely to fail than other companies. But if they fail, you would lose all of your money. I mean, it is that simple. And this is why what you want to be doing is getting into something that is safe while also reflecting your personal risk, like tolerance. So if you're somebody that doesn't like roller coasters, you may not like to get into individual stock picking because it is a bit of a roller coaster, and we'll get into that in more detail. How do you find a fund to invest in? We will look into that, Jasmine. If I haven't covered that by the end, remind me about the question. ETFs are good. eToro seems a good place. Not sure though, still a newbie. So eToro, very popular. It is social trading. So it's very much based on what are other people trading in, and do you have similar ideas to them? As always, there's risk involved, there's prices involved, be very careful. Where can we buy? I'm going to get into that as well a little bit further down. How are you always making money from the weather fund when you need to sell the shares to get the money? Right. So it's a little bit off piece, but let's cover that. You only make or lose money when you crystallize your money back. So as long as money is in a fund, right, you're not actually making or losing anything. Your paper value is going up and down, right? The shares have a higher or lower value, but you yourself do not have any more money until you sell it. When you sell it, you're either selling it when it's high, in which case you've made money, or you're selling it when it's low, in which case you've lost money. So yes, strictly speaking, you are making paper money. It's like if you own a home and it goes from being worth £100,000 to £200,000, if you're living in the home, you haven't made any more money. But if you sell it, you do. But that's a great question. The weather fund similar to the S&P 500, that's correct. Well, it's not correct. It's a subsection of the S&P, which is more of an index. Would be considered kind of like a fund, but it's made up of all sorts of companies. It's not like thematic, right? So the weather fund is specifically impacted by the weather. The S&P is impacted by geopolitical, global, and American events. So it's a fund of funds in a sense. I just want to, there's a lot of questions, and I just want to make sure that we get through everything. How would you go about investing in it? We'll get back to that. Lots of questions. We should just do a session where we just answer questions. People mentioning Vanguard. Vanguard's a good one. Will the recording be shared later? It can. The only money you make in investing in a fund is by selling it. Correct. The only time you ever actually receive additional cash is when you sell your asset. That is true for all assets, unless it is income generating, which we will get to in terms of dividends. All right, I'm going to move on because otherwise we are going to run out of time throughout. So what moves the market? And this is very much to the point about crystallizing your money and long-term versus short-term. And we'll talk about trading. In the very short term, the value of the market is determined by how people feel. Like literally, the market is a reflection of confidence, which is why what you see, for example, in the US is consumer confidence is reported. If people are feeling good, the market goes up. If people are feeling bad and depressed and demotivated, the market is down. So when you have an event like COVID in March 2020, the markets tanked. Now, there was no good reason for that in many cases. It was for the airlines because people couldn't travel anymore. But the banks and building and things like that plummeted 20, 30, 40%, it was just because people were really nervous. There was actually nothing wrong with the individual stocks. The smart money and people who can afford it get into the markets when the market is on sale. I'll say that again. People get into the market when the market is on sale. Amateur investors tend to pull their money out when markets come down. Professional investors come in when markets come down. So it's an interesting psychological thing. The next stock market crash, you will all view very differently if you were paying attention in March of last year, because you'll kick yourself for not having gotten in March of last year, and the next crash, you will more likely than not consider it. This is one of those things where having seen the song before can be very, very valuable. So what vehicles, and this is getting down into the specifics, right? 5 main points about wealth. The first is you cannot build wealth if you're holding onto a lot of debt. It is very, very difficult to do because the debt is always sitting there. Debt does not include mortgages by and large. If you have payday loan debt, if you have credit card debt, the best thing to do is get rid of that debt before you put money into the markets. Now, again, slightly contradictory because of what I said right at the beginning, which is that you should pay off your debt before you build assets because of how it works. If your debt is a 0% debt, then investing may make more sense than paying off debt. If your debt is 19% debt, then you're probably better off paying that. So the question for you is, where can every rand, where can every pound, where can every dollar make you the most amount of money? And sometimes it'll be in paying off debt, and sometimes it'll be in investing. You're the only one that will know, but it's purely based on the mathematics, purely based on the mathematics. Live within your means as a general rule. Don't spend your money trying to look rich. Use your money to get rich. Always better. Start small and finish big. You're never too young. I made my first stock purchase at 15. You are never too young to invest. You shouldn't invest money you can't afford to lose, and you shouldn't invest on impulse. But if you are ready to start small, start with 100 pounds, start with 100 rand, start with a small amount of money and get comfortable with it and learn and practice. Because if you are in your late teens, 20s, 30s, you've got a very long time to build your wealth. The earlier you start, the better. And I'll show you a graph in a second to prove that. Invest for the long term, which is very much what I'm saying, and make sure that you protect what you've built. Make sure you have your insurances. Make sure that you are investing in funds, to the question that was asked, that you are investing in funds that are seen as secure, that have got a history, that are being run by reputable organizations. If it looks too good to be true, it is. Repeat after me. If it looks too good to be true, it is. Always. Okay. So don't be flippant with your money. Don't be flippant with your money. So now looking at vehicles, again, a word to anyone who is not based in the United Kingdom. Some of these won't be relevant to you, so apologies. So for people who do live in the UK, the ISA, as you hopefully will have heard, the ISA is a tax-free wrapper. I want you to think of a bucket, and all the money that goes into that bucket will never pay tax on it. You get a new allowance every single year. That allowance is £20,000. It resets on the 6th of April because that's the beginning of the new fiscal year in the UK. Why? Nobody knows. Well, there is actually a good reason why, apparently, but it's ridiculous. So what you put into that bucket will always be protected from tax. That might not seem like a big deal, but if you've used your ISA allowance over the last 20 years, you would have something like £200,000 or £300,000 that does not get taxed. It might not seem like a big deal when there's £5,000 in there, but if there's £100,000 in there, that's a lot of money that you are not paying in tax, which is great. There's a couple of rules, of course, with the bucket. Money that goes in, if you pull it out, you can't put it back. And at the end of the year, that bucket is closed and you get a new bucket. You can't put anything else into that first one. Chances are you're not going to get anywhere near the 20,000 allowance, so you don't need to worry now, but hopefully going forward, you'll be wondering what to do with your money because you'll be filling the bucket and you'll be wanting to put it somewhere else. There are multiple types of ISAs. There is a cash ISA, which is only cash. And then there is a stocks and shares ISA. So you can buy your stocks and shares within the bucket. And again, no money that is generated from that will attract any kind of interest. Again, this is a particularly big deal because we know that stocks and shares can go up dramatically more than savings. You need to invest with a broker or platform, and the companies may charge you to hold on to your ISA. So just double check that as well. The lifetime ISA is something I want to highlight in particular to anybody who is aged 18 to 39 who is on the call. The lifetime ISA is basically free money from the government. If you are saving and you're saving into an ISA and you're between 18 and 39, use the lifetime ISA, get your money from the government. This is the last free money you will ever see. Basically, you can save up to £4,000 a year and the government will give you up to £1,000 for the year. That money can only be used to buy a home or to save for retirement, but get your free cash because once you're over 39, you can't access it anymore. Investments, so that's the ISA. So we're back now to global stuff. So buying any asset, if you are planning on selling it later or hoping that it will generate income, is an investment. I do not include cryptocurrency in this conversation. For anyone who's wondering about crypto, we are going to talk about it. But I'm a bit of a crypto skeptic. I do hold a little bit of cryptocurrency, but I would much rather at this point people were investing in regulated markets for the long term than trying to figure out which next bleep coin is going to, you know, go stratospheric. So just a quick word on that. When I speak about investments, I am not talking about crypto, but we will cover that at the end. There are a few different types of investments. There are shares and there are funds, and somebody else was asking about bonds as well. So what do they all mean? So a share, as we were talking about with the ice cream company, a share is when you buy a chunk of a organization. You become a shareholder. Shares and stocks, we use the words interchangeably. The word share should give you an idea. You are now sharing in the profits or losses. Well, not losses because you don't have to pay any money, but you are participating in the fortunes of that company. In order to do it, you open an account. It really is quite straightforward. You open an account with a broker. Make sure that the broker is a reputable broker in the country that you are in. If you just Google buying shares, a whole bunch of different companies will come up. You open the account, you put into a little bit of money, and then when you want to buy something, you buy it. It is literally a supermarket of companies. So you look on the shelf, you pick the one that you like, and you buy a little bit of it. Now, that is not to say that there isn't risk, because there is. There is a lot of risk in the stock market. There is short-term risk, like, for example, when everything crashed with COVID. And there is longer term risk where there are companies that fail. There are companies that are huge companies. I'm thinking Kodak. I'm thinking Enron. These were massive companies in the 90s that went from, you know, a huge organization to zero. People lost all of their money. You have to bear in mind the risk always as you are going along. Funds, as we went through again with the weather fund, funds is when a lot of people's money is pooled together, and the fund then buys a range of different assets that are then held together. There are usually fees attached to that because the fund is managed. There is a person involved or people involved, and that needs to be paid for. And you can either put money in to it as a lump sum. So you have £1,000, 10,000 Rand, and you put all of that money into a fund, or you can buy over time. It's known as dollar cost averaging in order to smooth it out. And I'll show you what that means. I think dollar cost averaging is a vehicle that too many people don't use, and it's terrific. And I'll show you why. Funds are less risky, but nonetheless risky. And you can have funds that are riskier than individual stocks. So you need to be very careful. An example of that, and then we'll go to questions. If you imagine buying a fund, which is a Venezuelan fund, or you buy an Amazon stock, chances are the Amazon stock is safer and less risky than the Venezuelan fund. So there are super risky and less risky funds, and there are super risky and less risky shares, but there is always, always, always the possibility of losing money. Let's go to quite a lot of questions. How much Oh, all right, let's go here. This is not, sorry. Zoom's question function is like not great. The only money you make out investing in the fund is by selling it. Correct. Okay. Would you include student loans as debt? If Vivian, if you are in the UK, then I would not consider student loans as debt. I would not be paying that loan back earlier. We can have a conversation about that at the end of the call if you would like. As a general rule, in this country at the moment, unless you are earning over £75,000 a year, you will not be repaying your full student loan. It is not worth paying it back early. If you are going to be earning over that, then you should consider repaying it. It's a much more involved conversation, but for the purposes of this, I would not consider student loans to be a debt that you should consider. Would student debt be an issue for wealth? Again, it depends how much you're earning and whether or not it's worth paying off. Student debt, although it's a bit of a in this country, it's actually not nearly as bad in terms of consequences as you might think. And if there are more questions about that, we can look at that at the end of the call. So if people want to talk about that later, I will ask the question before we wrap up, and we'll spend 5 minutes doing it. Is it better to have a stable job income before investing? It is, Dana Marie, it's a really interesting question. It is better to make sure that any money that you are investing is not money that you are relying on to pay your bills. So whether that's, some people in a stable job are making £8 an hour and other people are gig economy and they're making £1,000 a day, right? So it really depends on definitions. Don't invest money that you cannot afford to lose or that you cannot afford to wait for until it comes back up. So if you had invested on the 1st of March and then the market tanked on the 20th of March, but you could wait, then actually if you had liquidated it yesterday, you'd probably be up, right? But you need to know that you can wait that period out. If you can't wait that period out, you should think twice about investing. The amount of student loan you repay is not a guaranteed. It could cost you anywhere from 0 to 50,000 depending on future income. Gemma, it's actually worse than that. If you are a lower salary person, your total debt could end up being like 150, 160,000. If there are a lot of UK people on the call who want to talk about student debt, we'll do that at the end. How much money do you need to invest initially? Depending on where you are, I would usually recommend starting with £100. £100. Get yourself comfortable. Members of my team who'd never invested before started with 50, just to start getting a feeling for it, to start to understand how it works, start to understand how you feel riding that roller coaster of the stock market. But you can actually start with very, very little. I would say 50 to 100 is a good enough amount that for most people, if they lost that, it wouldn't be catastrophic, but it's enough that you can start to see what happens as things move up and down. How did you start investing at 15? Jude, I started everything very early. My mother had to buy the stock for me because I was too young. I bought a banking stock back in the day. Moneybox is great for stocks and shares ISAs, says Jasmine. Is the LISA only for UK citizens? The LISA is only for UK resident for tax purposes. So if you are resident for tax purposes in the UK, then you can use all of the ISAs, but you need to be resident for tax purposes, which doesn't mean a citizen, but you do have to be paying tax in the country. LISA versus stocks and shares, which would you put your money in first? So I would personally, and this is not advice, make your own decision. The LISA gives you free money because the government is giving you £1 for every £4 that you invest. I would always happily take the government's money. That said, it can only be used for retirement or for your first property. So if you don't plan on buying and you don't plan on worrying about retirement, then the LISA, the government will then claw back that money if you're using it for other things. So that's the consideration I would make. But all things being equal, I would always take money from the government if I could. What happens when you want to withdraw what you've made in your investments after 50 years? Do you get in a lump sum? So I don't know what's going to happen in 50 years in terms of taxation. I wish I did. I'd be playing the lottery. But when you pull out the money of the ISA, once you pull it out and you then use it, you may then get taxed, but while it's in the bucket, you don't. So it really depends, but I have no idea what the tax system will be like at that point. Assume always that taxes will go up, because then it's always a pleasant surprise if it doesn't. With Elisa, can you take out money for your first home? Yes, you can. Keep some in for more. Yes, you can. No, it is not a one-time withdrawal. You can withdraw, 1,000 times if you wanted to. the money that is there can be withdrawn however you like. I am not sure of the tax consequences when you then do other things with that money, but you don't have to remove it in a lump sum, but you do have to use it for retirement or for housing. Want to buy a house and I'm saving for it, but also want to get into investing, as I know compound interest helps more if you start early. Is it possible to do both? So the problem that we currently have with savings is that the bank interest rate is so incredibly low, like maybe 0.5%, 1%, if you're really lucky. Investing could and should give you a higher return, but it is also higher risk. So it really depends on the time horizon, the amount of time that you're looking at, as to whether, if you're buying for something specific, you have it in savings or investing. I can't give you advice on that. I would run your numbers. And if you're not investing, I would start small. I wouldn't start with a huge amount of money. What happens if you open an account, invest in the UK, but move somewhere else later? That's fine. That money is always yours. That money is always yours. What happens to your tax status if you are no longer resident for tax purposes? I am not sure about. Speak to a tax accountant always. Dollar cost averaging, I'm going to go to the next, slide. It is not too good to be true, and I'll show you why in a second, but you're right. If something seems too good to be true, it is, but dollar cost averaging, I'll show you in a second. How much can you deposit with a lifetime ISA? You can put in £4,000 a year and the government will give you one. What does the government put in plus the interest it made? If you use it for something other than your house deposit or retirement, you'll find 25%. That is exactly right. That money is only for buying a home or retirement. If you don't use it for that, then the government will claw back any money that they've given you. It's up to £4,000 a year. That's correct. All right. So let's talk about dollar cost averaging. Oh, where did I put dollar cost averaging? All right, let's have a look quickly. All right. So it must be further down. So there are, oh, just conscious of time. All right. So there are a range of different types of funds. We were talking about funds before. So from the broadest to the most specific, a managed fund is the weather fund that we were talking about. It's a pot of money. Different investors put it in. An individual or a group manage it. That is a managed fund. It is also called a mutual fund in some places. It has the same meaning. You can buy it within an ISA. So stocks and funds usually can be bought in an ISA. An index fund is when you are investing in an index. So when somebody was asking earlier about the S&P, that you could buy an S&P index fund. The S&P is an index in the United States. And what it is if let's say the S&P had 5 shares in it, so Amazon, Apple, I can't even think of 3 other companies, Barclays, Marks and Spencers, and Sainsbury's, then the index fund would hold exactly the same in exactly the same proportion, right? That's an index fund. So as the S&P goes up and down, so the fund goes up and down, right? It is Warren Buffett's favorite way of investing. So if you're interested, if you think Warren Buffett may be onto something, have a look at what he says about index funds. A slightly more specific version of an index fund is an ETF, which is an exchange traded fund, which means that it is traded like a stock. What does that mean? An index fund is priced once a day. An ETF is priced all day. So if you look at Barclays in the UK, for example, the price of a Barclays share changes literally every second. Right? Every second. It's very highly traded and it goes up and down every second. An ETF does the same. An index fund, it has one price a day. So this is the difference between the ETFs and the regular funds. Another type of asset, of course, is a mortgage. A few people said that they are looking to buy property. A mortgage is a loan that is specifically used to buy property. These are UK numbers. You need to put down usually a 10% cash deposit. So if you are buying a home in London and it is a £300,000 home, which is about average at the moment, you will need to put down a £30,000 cash deposit. You will then borrow the rest from the bank. The way that the mortgage is calculated is based on 4 to 5%. Or 4 to 5 multiple of your salary. So if your salary is £10,000, the bank will lend you between £40,000 and £50,000. So what you can see is the higher your income, the more likely you are to be able to borrow the money. And this is why mortgages are so difficult. Getting together a £30,000 deposit is not easy. And being able to then borrow the other £270,000 means that you need to be on at least a £50,000 a year salary. So you can see why a lot of the talk at the moment about young people getting on the property ladder, you can see why it's such a complicated and expensive process. The earlier you start saving, the earlier you start investing, the more you use things like the lifetime ISA, the more likely you are to be able to reach these numbers, but they are very, very, very high. We'll have to see what government or policymakers make of it. You pay the mortgage back plus the interest component, usually over a 25 to 30-year term of the mortgage. And then finally, the last asset class is your pensions. Right at the beginning, I said that there are two things you want to make sure you never do. You don't want to run out of money before you run out of month, and you don't want to run out of money before you run out of life. The pension is the second one. The idea behind a pension is that when you stop working, between stopping to work and stopping to breathe, you still need to be paying for things, because unfortunately that doesn't stop. You still want to eat. The pension is designed to cover that. In the UK, we now have what is known as auto-enrollment. So your employer has a legal obligation to contribute to a pension on your behalf as long as you are contributing. How that works is different in different companies, but there are now minimums. This is going to sound a little bit cynical. I do not believe that by the time I, certainly not you, will retire, will there be a state pension? And if it is, it will not be enough to live the kind of life that you want to. The best thing to do is assume that there will be no state pension and that you will only have at retirement what you have saved for retirement. So just something to be aware of really early. There is going to be not a lot of money, and there are going to be a lot of people. To claim the state pension, you're probably going to need to be pretty badly off. You don't want to be there. Start early, use your auto enrollment, contribute as much as you can to get the maximum from your employer, and then put the rest into other kinds of investments. Pensions, we could do a full hour just on pensions, but this is kind of the headline of it. And then, as I said, a quick word about crypto. We will see whether cryptocurrency has a lifetime value. There's a lot of countries that are cracking down on it. We don't yet know what's going to happen. There are very big regulatory problems. The US dollar has a huge impact. The central banks are starting to get in on the game. Be very careful putting your money into crypto. I can't emphasize that enough. It is currently the most risky on an absolute term. And I know that there's people who say that US dollar is risky because of inflation. All of that stuff may be true. Be very careful with crypto. There's a lot of charlatans out there. There's a lot of scams and fraud. Just be very, very careful. So investing versus trading. This, I think, is where my dollar cost averaging is, I hope. Let's quickly have a look at some questions. Okay, there's somebody's being very helpful. Thank you, Jasmine, for being helpful. Can you provide good book recommendations? I've actually got books right at the end. So I'll hold on to that so you can screenshot it. Okay, excellent. People talking, referring their own things. Great. I'll check that out. Thanks, Jasmine. Great. If somebody had a much higher than average income, would they be eligible for a higher mortgage multiple? Usually not. Usually the maximum that any bank will give you is 5.5 X, so 5.5 times the salary. But if you have a higher income and you've got a higher deposit, then you might need less money to cover it, right? Everyday Millionaires, okay, books, University of Law, Manchester. How can we use current news to help us make smart investment decisions? Jason, that is the big question. As we said earlier in the earlier up here, the prices and value are in the short term very much about market sentiment, and that's about the current news. But in the long term, the question is the company stable? Are they making money? Are they selling stuff, whatever it is that they're selling? And for that, you have to look at things like their balance sheets. And if we've got time, we will go into the market and have a look. We're going to cut it close with timing. All right, so the difference between trading and investing. Trading is about buying for short-term profit. Investing is about buying for longer term, right? Now, longer term can be anywhere from kind of 1 to 3 years all the way through to 10 or 15 years. Trading is usually daily or weekly. So it's very different. They're very different ways of approaching the markets. We're going to come back to that. But if you have a look over the long term, I think this graph is really interesting. I haven't yet found this for the FTSE or any other index, but this is the Dow Jones over the last 100 or so years. The Dow Jones is one of the big US exchanges. On the left-hand side, unfortunately, you can see it's not well spaced. So there's a big space up to 2,500 between, but from 15,000 to 30,000 is smaller. So otherwise it would be much, much steeper. But the gray vertical lines are recessions. So one of the points to get out of this is recessions are really common and they happen a lot. The other thing to see out of it is that recessions, as a general rule, tend to not last that long. They tend to be about 6 months to 12 months. A difference, of course, is in the Great Depression in 1929, which is this big fat gray over here, where you can see a massive decline from about 6,000. If you think about this in value, from about 6,000 down to about 100, there is a reason stockbrokers were jumping off buildings, literally. If you scooch over to the far right-hand side to 2008, this was the financial crisis. And as you can see, the drop was from about 17,000 down to about 7,000, so pretty significant, but then it pretty quickly recovered and continued to go up. What is my main message? My main message is that as much as the past does not tell us the future, we can also see that the market trends in an upward direction. So even if you bought 5 minutes before, if you bought here on the left-hand side of this last gray recession in 2008, if you bought just before the recession happened and you went from 17,000 to 7,000, if you were able to hold your nerve, then within 2 years, you were back to where you were. Within 4 years, you were even higher, right? But if you sold at the bottom, you would have lost, you know, 50%, 60%, 70% of your money, which is what I saw when I was in banking at this time. People were losing huge amounts of money because they panic sold. If you can not panic and you can not need the money, then usually the market recovers, usually. And what tends to happen is professional investors and people who've seen recessions before, what did they do? They bought at the bottom because it was on sale. The stock market was at a 50% discount and people bought at that point. The reason I suggest you get started in investing early is that you will then start to get a feeling for what happens, and most importantly, for how you react to the things that happen. All right, there's a couple of reasons why investing. First of all, it produces greater returns over time. Again, this may not be true going forward, but it has historically been true. The FTSE 100, which is the main exchange in the UK, on average gives out little under 6.5% a year. At the moment, with interest rates being 0.1, that is 60 times more than savings. It is, of course, more risky. And the fact that it's an average can mean that for 5 years, you're getting 30%. And then in the last year, you know, for 5 years, you're getting 0%. And then you're getting 1 year of 40%. And then they're doing averages, right? So be very cautious. But as a general rule, investing produces better returns. It is a greater hedge against inflation. It is also more tax efficient. So first of all, if it's in an ISA, you're not paying any tax on it. But even if you are, you're paying a lot less tax than you would be in savings because of the way our tax code is written. Again, this could change over time. How do you actually start practically? Decide you want to. Get learning. If you are hopefully fortunate enough to have the Blackbullion platform, everything you need is inside the platform. Learn about the differences between stocks and funds and what you want and what your ambitions are and what your time scale is and how much money and what is the ambition. Do a dummy run. And what I mean by that is pick a couple of stocks or funds and watch them. Keep an eye on what they do on a regular basis so you can see how you react. Open an account, set up a standing order, start investing, dollar cost average down. What the hell does that mean? This. All right. So I knew this graph was here somewhere. So what dollar cost averaging means, and it should be pound cost averaging in the UK and rand cost averaging in South Africa, but this is just the way the term is called. Dollar cost averaging is when you buy a little bit every month, regardless of the price. So as you can see here, you're putting in £200 every month. Let's say that these dates are months. Every month you're buying £200 of the same share. In the first month, you're getting 133 shares. In the second month, because the cost has gone down, you're now getting 200 shares and onwards and onwards and onwards. Now, what you can see after 10 months, it is 10 months, yep. What you can see after 10 months is you've invested £2,000, but you've got £3,000 in return. Now, of course, that could be £1,500, right? There's always risk. but you've got £3,000 in this particular case because you are some months getting more and some months getting less. Now, if you had put all £2,000 in on the first month, you'd have a very different amount than if you put it in the second month or in the 10th month. The problem is you can't time the market. So it's impossible to know whether you should buy this month or next month, right? Because you don't know what's going to happen to the price. So if you set up a standing order, a regular payment, then it's automated. You will buy however many you manage to buy in that month. And over time, you can smooth it out. So as you can see, over time, you've paid £1.48 per share. Okay, so that's how dollar cost averaging works. I'm personally a big fan because I don't believe, I'm not arrogant enough to believe that I know what's going to happen next. And if you allow your money to work for you and you let technology do the heavy lifting, then a lot of the time, not always, it'll work out in your favor. So that's how dollar cost averaging works. Trading, on the other hand, is about fast moves, right? So the idea is that you trade at any point, at any time, on any exchange. Check that whoever your brokerage house is allows you to do that anywhere, because not all brokerage houses allow you to buy everywhere or at any point. And what traders do is they take advantage of rising and falling markets. So you come in, it goes up or down 2%, depending on what you're buying. You make 2%, you come out, you come in, you make 2 or 3%, you come out, you go in. Long-term investing is about wanting to get a 50% return over the next 10 years, for example. So this is the difference, right? Trading is riskier because usually you're only trading individual stocks. So it is more risky than diversification. Last couple of points. Forgive me if you are offended by my word dumbness, but these things are dumb things to do on a technical level. Never, ever, ever take a leveraged position. What leverage means is that you're putting in $1, but you're playing as if it was 10. If you are leveraged times 10, some companies like Robinhood allow this even for non-professional investors. I don't believe that should be allowed. This is how people get into big trouble. It means that you can lose a lot more money than the money that you put in. It is very dangerous. Don't do it unless you're a professional. And even then, a lot of people have lost their shirt doing this. Don't try and time the market for all the reasons we've already discussed. Don't trade in illiquid stocks. Illiquid stocks are stocks that other people don't want to buy. So if there's only 5 buyers for the stock that you buy, when you want to sell, you're going to have a hard time. If you are buying a highly traded stock like Amazon, like Apple, like Barclays, there will always be a buyer if you are a seller. So if you buy illiquid stocks, things that nobody wants to buy, it is, again, much more risky. Don't think that cheap is valuable. About a year and a half ago, a lot of people bought Hertz. Hertz, for anyone that doesn't know, is a bankrupt car leasing company. Don't do things like that. In this, the lemmings end up losing a lot of money. And don't believe that all stocks bounce back. They don't. There are plenty of companies that have gone under. Don't get involved in that. And emotional dumbness, again, this is human emotion. Don't make decisions based on what your girlfriend's best friend at work's father's wife's best friend told you was a hot tip. Don't ever do that. It's never a hot tip. If it is, it's insider trading. So there's never an upside. Don't be aggressive if you can't afford to do it. Don't be emotional, which is the hardest part, certainly for me. If you've made a bad trade, sometimes the best thing to do is to lose the money and get out, and never, ever, ever invest more than you can afford to lose. That is actually the biggest issue. Again, choosing a trading app is much the same as choosing an investment app. Just make sure that you're very careful in terms of pricing and in terms of timing, and that it is a reputable company. There are a lot of fraudsters out there. Be very, very careful. You were asking about things to read. These are my most highly recommended books. Some of these are really old books. The Intelligent Investor is absolutely worth it. It's about this big. It's absolutely worth it. If you follow us on our Instagram, you can also get a free copy of one of these. As I said, chuck it in there a little bit. I do recommend The Richest Man in Babylon. I think it is a fantastic fable. It's not very long. It's a very quick read. I think it's outstanding. Please feel free to screenshot this. I'm going to move to the next one in 3, 2, 1. Next.